You wore a suit your first day. Nobody else did. That's lesson one, and it cost you nothing except a little dignity. The fund manages $4 billion across a long-short equity strategy. You understood what that meant when you wrote it on your cover letter 4 months ago. In practice, it means you spend your first 6 weeks building a data model covering 200 public companies' operating metrics, quarter by quarter, across 5 years. You're not pitching ideas. You're laying concrete. The analysts who came before you laid the same concrete. The ones after you will too. Your desk faces a wall. You have 2 monitors and a Bloomberg terminal that costs the firm $2,000 a month to license. You learn to move between screens without thinking, the way a chef moves between stations. By month 3, you can pull a company's earnings history, cross-reference it against its credit default swap spread, and have a rough view of management credibility, all before your second coffee. Your day starts at 6:50 a.m., not because anyone told you to, because the senior analyst walks in at 7:05 and you've already decided you'll never be the last person through the door. That's not ambition talking. That's pattern recognition in its earliest form. You've noticed that the people who survive in this building are always slightly ahead of the moment. The work is precise and relentless. You rebuild a regional bank's loan loss provision model from scratch because the sell-side analyst got lazy in Q3 and your PM catches lazy. You write a 2-page summary of a biotech competitor's pipeline and cut it to 1 page because nobody here reads past the first. Brevity isn't a courtesy in this industry. It's a signal that you understand what actually matters. Your compensation this year is $110,000 base. Bonus brings it to $160,000. You grew up hearing that number described as success. 3 months in, you realize it isn't a reward. It's the price of your hours. Your first relationship ends inside year 1. Not with a fight, with a slow withdrawal, the kind that happens when someone realizes they're always competing with something they can't see. You tell yourself it's temporary. You tell yourself the sacrifice is building towards something. You're partly right, which is the most dangerous kind of wrong. What you're gaining right now, though you can't feel it yet, is a mental library that most people never get access to. You've seen 200 companies in forensic detail. You know what a deteriorating margin profile looks like before it shows up in headline numbers. You know how management uses language to bury bad news inside optimism. You are building the foundation of genuine judgment. You just can't spend it yet. The PM calls your name in the morning meeting, not "someone check this." Your name, specifically. Your answer takes 40 seconds. He nods once and moves on. That nod is the most significant performance review of your career so far, and nobody in the room noticed it happen except you. You're in year 3 now. Your title changed. More importantly, what you're being tested for has changed. You're no longer building infrastructure. You're being evaluated for judgment. And those are completely different exams. You pitch your first idea. A mid-cap industrial company at a discount to peers, undervalued because the market hasn't priced in a new management team that you've spent 6 weeks studying. You know their track record at the previous company. You've modeled the margin expansion potential under their operating philosophy. You go long at $34. 3 weeks later, the stock is at $28. Not because your thesis was wrong, because the whole sector rotated on a macro call that had nothing to do with your company. Your analysis was correct. Your timing was off. In this industry, the distance between right thesis and right timing is measured in careers, not basis points. Your PM doesn't cut the position. He holds it. He tells you, once, briefly, the way people talk when they're not interested in repeating themselves, that patience is a risk management tool, that a good thesis with bad entry is still a good thesis. 6 months later, the stock closes at $41. You made money on a bad trade. You will think about that sequence more than almost any win you'll have in the next 5 years. This is also where the concept of edge stops being a buzzword and starts being a real question you have to answer about yourself. Edge in a hedge fund means you understand something the market hasn't fully priced yet. Not a rumor, not inside information, a structural insight, a pattern, a relationship between variables, a data source that's publicly available, but that almost nobody is using the way you're using it. Without Edge, a fund is just paying 2% management and 20% performance fees to own the market. Nobody with $1 billion does that by accident. You find yours in consumer transaction data, specifically the gap between what retail companies report in earnings and what anonymized credit card spending data shows about actual customer behavior in real time. You're one of maybe 50 people in the world working this particular signal in this particular way. That's what Edge feels like. Quiet, specific, slightly uncomfortable to explain out loud because the moment too many people understand it, it stops working. You have a book, not the whole fund, a sleeve. $300 million of capital allocated within your coverage universe. Your P&L is tracked in real time, not daily, real time. A number that changes every second the market is open, directly tied to every decision you've made this week. Your compensation floats on that number in a way nothing in your career ever did before. The first surprise, the loneliness of it. You expected ownership to feel like freedom. Instead, it feels like weight you carry alone. When you were an analyst, a bad call was a lesson. When you were a junior PM, a bad call was a conversation. Now, a bad call is $6 million of drawdown before lunch. And the people around you are professional enough not to say anything, which somehow makes it heavier. You absorb it quietly. Then you make the next call. Your total compensation this year crosses $1 million for the first time. Your apartment is better. Your car is better. Your hours are identical to what they were as an analyst. The moral geometry of this work starts to show its actual shape at this level. And it's not as clean as you thought it would be from the outside. You're long a pharmaceutical company whose drug genuinely works. You've done the clinical analysis, spoken to the relevant physicians, modeled the revenue curve conservatively. But the company's communications around a minor safety signal in a recent study are, at minimum, misleading. The stock is going up. Your position is up $22 million. You hold the position. We all have a line. The question this industry asks you, quietly, repeatedly, always through something small rather than something dramatic, is where that line actually is. Not where you said it was when someone asked you at a dinner party. Where it actually is at 9 p.m. on a Thursday when the alternative to holding costs you real money. This is the level where you find out the honest answer to that question. You've been at the fund for 9 years. 3 PMs have rotated out in that time. 1 left for a family office. 1 burned out and quietly moved to a smaller fund in Connecticut. 1 had 2 consecutive down years and was asked to leave in the language this industry uses for being asked to leave. A mutual decision to pursue other opportunities. You've had 1 down year, a macro environment where almost everyone had a down year, and 2 years in which you outperformed your benchmark by 8 points and 11 points, respectively. The partners have started including you in conversations that aren't about your book. That is the signal, not a title change, not a memo. Access. Your first LP dinner is in a private room where the menu has no prices. The man across from you manages a sovereign wealth fund with more assets under management than the GDP of a mid-sized country. He asks you, over the first course, to describe your position sizing process. You give him a clean 3-sentence answer. He nods and moves on. That was an audition. You won't find out for 6 weeks that you passed. Your carry kicks in meaningfully at this level. The structure of most hedge funds means that as a senior partner track PM, you participate in a percentage of profits above a hurdle rate, usually 20% of gains. On a fund the size of yours, 1 strong year means that number is life-altering, not in a lifestyle sense. Your lifestyle adjusted 2 levels ago. In an architectural sense, the kind of wealth that doesn't change what you buy. It changes the structure of how you own everything. What also changes at this level is how you think about time. As an analyst, you thought in quarters. As a PM, in annual cycles. Now you think in fund vintages, 3 to 5 year windows. Your edge isn't about what the market does next month. It's about what the structural landscape of a specific sector looks like in 3 years, and whether you're positioned in front of that reality before the consensus discovers it. Your name is on the fund documents, not metaphorically, legally. The fund manages $7.4 billion. You oversee 3 portfolio managers, each running their own sleeve. You set the macro framework, the view of the world that all 3 books operate inside. When you say the fund is reducing emerging market exposure over the next 2 quarters, Roughly $900 million repositions in the weeks that follow. You don't execute the trades. You set the direction, and the direction becomes action. The work is mostly conversation now. An hour with a former central bank economist in London who sees something forming in European credit markets. A private dinner with the CFO of a company you're considering building a significant position in. A call with a Singapore-based allocator who is deciding between your fund and two others for a $300 million commitment. You are the argument for the fund now. Your judgment, your track record, your capacity to articulate exactly why this fund sees the world differently from every other fund competing for that capital. That is the product. You sleep 6 hours. You exercise at 5:30 a.m. because it's the only hour that belongs to you alone, without negotiation. You see your family on weekends when there isn't a closing. You tell yourself the sacrifice is still finite, still building towards something. At some level, you've stopped needing to believe that to keep going. There's a question that surfaces at this level, one that never came up below it, and it arrives not in a dramatic moment, but on an ordinary Tuesday afternoon between two calls. The question is, what's the number? Not philosophically, mathematically. The figure at which your carry interests, liquid portfolio, and fund economics make additional work entirely optional. You model it the way you'd model anything. Assumptions, scenarios, a range. You arrive at a number, you look at it for a moment, then you take the next call. Because what nobody tells a 23-year-old analyst, what this entire industry is structurally incapable of saying out loud, is what actually keeps people here past the point of financial necessity. It isn't greed, not at this level. It's something more precise and harder to name. Pattern recognition addiction. Your brain has been trained for 15 years to find signal in noise, to see what the market hasn't priced, to be right about something important before the consensus catches up. That process, the hunt, the thesis, the waiting, the resolution, produces something on a neurological level that nothing else in your life replicates. It's not about the money. The money was always downstream of something else. It was always just how the machine kept score. Somewhere right now, a 23-year-old is walking into a glass tower for the first time. Good shoes, pressed shirt, the quiet anxiety of someone about to be tested in ways they haven't studied for. They think it's about intelligence. Partly, they think it's about discipline. Partly, they think it's about money. And that's where it gets interesting, because the people who last in this world aren't the ones who wanted the money most. They're the ones who, somewhere along the way, stop being able to stop. The only real question worth asking before you walk through that door is whether you're ready to find out if you're one of them.